August 1998. It's a hot summer day, but the air feels frozen. Long lines stretch outside the banks, men in worn jackets, women clutching their savings books. Some whisper to each other, others just stare silently at the locked doors. Inside, tellers sit motionless. They have nothing left to give. The government has just announced default. The ruble collapses overnight. The dollar, which had cost 6 rubles only days ago, now costs 20. Wages vanish. Deposits evaporate. People's life savings gone in a heartbeat. How did it come to this? How did one of the largest nations on Earth, rich in oil, gas, and minerals, descend into financial chaos less than a decade after the fall of the Soviet Union? And the question that echoes to this day, could it happen again? To understand this moment, we must rewind to 1991, the year the Soviet Union collapsed. For 70 years, the USSR had operated under a planned economy. Prices were fixed, markets didn't exist, and the state owned nearly everything. When the Soviet system dissolved, it left behind confusion, scarcity, and chaos. Russia inherited enormous foreign debts, a collapsing industrial network that had depended on the other Soviet republics, and no experience running a market economy. In 1992, President Boris Yeltsin's government introduced what became known as shock therapy. It was meant to transform the economy quickly from socialism to capitalism by freeing prices and privatizing state assets. But the shock was far greater than anyone expected. Overnight, prices soared by thousands of %. A loaf of bread that had cost a few kopecks suddenly cost rubles. Inflation in 1992 alone reached more than 500%. Salaries couldn't keep up. Savings evaporated. People who had worked their entire lives found themselves in poverty. Yet, despite the pain, the government believed this was the only way to rebuild, that after the initial chaos, markets would stabilize and prosperity would follow. But the promise of a bright future turned into years of instability, corruption, and inequality. By the mid-1990s, Russia seemed to be recovering, at least on paper. Western advisors praised the transition, foreign investors poured in, Moscow's skyline began to change. Banks appeared everywhere, and businessmen flaunted newfound wealth. But beneath the surface, the recovery was built on sand. To cover enormous budget deficits, the government started issuing short-term bonds, called GKOs, government treasury bills. These bonds paid extremely high interest rates, attracting both Russian and foreign investors. The logic was simple. The state borrowed money to pay off earlier debts, a cycle that only worked as long as people kept lending. It was, in essence, a national pyramid scheme. The government spent beyond its means. It collected little in taxes, relied heavily on loans, and kept promising stability that it couldn't deliver. At the same time, oil, Russia's main export, was selling for just $10, $12 per barrel. That meant the country's main source of income was drying up. To maintain the illusion of stability, Russia pegged the ruble to the dollar at roughly 6 rubles per $1. This fixed exchange rate created a sense of control. It reassured citizens and investors alike. But keeping the ruble stable meant the government had to spend billions of dollars in reserves it didn't really have. In 1997, the Asian financial crisis erupted, sending shockwaves through global markets. Investors fled developing economies, pulling their money back to safer places. Russia, heavily dependent on short-term capital, was suddenly left exposed. Its debt ballooned. Foreign reserves dwindled. Oil prices fell even further. The Russian government tried to hold on, borrowing even more, raising interest rates, and asking the International Monetary Fund for emergency aid. But it was already too late. On the 17th of August 1998, Russia officially declared default on its domestic debt. The ruble was devalued, and the government froze payments on foreign loans. The reaction was immediate and catastrophic. Banks collapsed overnight. The stock market plunged by more than 70%. The ruble lost 2/3 of its value within days. People ran to withdraw money only to find their accounts frozen or empty. The illusion of a new, stable Russia vanished in a week. Foreign investors fled. Trust in the government evaporated. Salaries and pensions went unpaid for months. The economy contracted by over 5% that year, and inflation once again soared. For ordinary Russians, it felt like the 1990 seconds had come full circle, another round of survival in a system that promised prosperity but delivered despair. The 1998 default was a national trauma. Yet, in a strange twist, it also marked the beginning of a slow recovery. When the ruble collapsed, imported goods became too expensive. For the first time in years, Russian factories could compete again. Domestic production began to grow. The devaluation, painful as it was, gave local industries a lifeline. In 1999, Russia's GDP grew by more than 6%, signaling the first real economic recovery since the early 1990s. However, this recovery didn't come from reform, it came from circumstance. The structural problems that had led to the crisis, corruption, weak institutions, dependence on oil, and speculative finance, remained firmly in place. By the early 2000s, as global oil prices began to climb, Russia's economy surged again. But this time, the growth wasn't due to strong reforms or productivity. It was the result of a new oil boom. The crisis of 1998 had revealed the fragility of Russia's system, yet instead of building something new, the country rebuilt the same model on a larger scale. In the years following the default, the government took steps to stabilize the system. The tax reform of 2001 introduced a flat 13% income tax, simple and efficient. The central bank tightened control over currency operations and created mechanisms to manage foreign reserves. Yet these improvements didn't address the deeper issues. Russia's economy remained heavily tied to oil and gas exports. Financial markets stayed shallow, and corruption deeply rooted in both politics and business continued to undermine growth. The 1998 crisis wasn't the end of instability. It was merely the pause before the next storm. More than 25 years have passed since that fateful August. The world has changed, but the echoes of 1998 are still audible. Today, Russia once again faces sanctions, fluctuating oil prices, and a volatile ruble. The government increasingly relies on internal borrowing, issuing bonds that domestic banks are compelled to buy. Foreign investment has shrunk, and the ruble, though no longer fixed, remains vulnerable to external shocks. The patterns are hauntingly familiar. Heavy dependence on raw materials, tight state control over markets, financial stability built on managed perception rather than real diversification. History doesn't repeat itself exactly, but it rhymes. The late 1990s remind us that even the strongest economies can collapse when trust, the invisible foundation of any financial system, is broken. The 1998 financial crisis offers three timeless lessons, not just for Russia, but for every economy. Lesson 1. An economy built on debt is a ticking clock. When governments spend more than they earn, borrowing becomes survival, and survival always ends in collapse. Lesson 2. A fixed exchange rate may look safe, but it hides the truth. Artificial stability only delays the crisis, and when it breaks violently. Lesson 3. The greatest wealth of a nation is not its oil, gas, or gold. It's trust. Without trust between citizens, banks, and the state, no currency, no budget, and no plan can survive. Today, as financial pressures rise again and the global economy enters uncertain waters, remembering 1998 is not just about history, it's about foresight. Because the past doesn't vanish. It waits quietly to remind us what happens when we forget. The financial collapse of the late 1990s was not just an economic failure. It was a story of misplaced faith, of promises made and broken, of lessons learned too late. But every crisis leaves a trace, a warning. And perhaps the most important one is this: prosperity built on illusion always ends in reality. Subscribe for more deep dive stories that reveal how history's biggest moments continue to shape our world today.